One of the questions I get most often from investors who are new to the aviation infrastructure thesis goes something like this. This all sounds compelling, but is it just a theory? Has anyone with real institutional capital actually done this? And the answer is yes, emphatically yes. Today, I want to walk through the institutional validation record because I think it's both a confirmation of the thesis and a roadmap for understanding where the opportunity still exists. Let's start with the most recent and, in some ways, most significant data point. In January 2026, Bain Capital Real Estate made its first ever investment in the FBO sector, acquiring App Jet Center. Now, Bain is not a firm that makes casual investments. When they enter a new asset class for the first time, it means they've done deep diligence and they believe the thesis is sound. What's particularly interesting is how they described their rationale publicly. They said App operates at attractive, capacity constrained airports. That language is not boilerplate. They specifically identified capacity constraint as the investment thesis. That's our thesis, almost word for word. And they didn't just acquire it to hold. Bain's managing director explicitly said that they intend to expand the app platform into additional supply constrained markets. So Bain has entered the sector, validated the thesis with a real transaction, and publicly stated that they're looking for more of the same. That's an institutional buyer telling the market, we want more of this. Before Bain, there was Apollo. In November 2023, Apollo Global Management, one of the largest alternative investment managers in the world with over 600 billion in assets under management, acquired a majority stake in Modern Aviation. Modern Aviation is an FBO platform that was founded in 2018 and grew from zero to one of the larger national networks in just 5 years, specifically by targeting supply-constrained airports. Apollo cited clear growth prospects across new and existing locations as their rationale. The fact that Apollo was willing to pay a multiple for a 5-year-old FBO company tells you a lot about how they value the underlying infrastructure economics. And the list doesn't stop there. You've got KKR backing Atlantic Aviation, one of the two largest FBO networks in the country. You've got Global Infrastructure Partners involved in Signature Aviation, Carlyle, Ares Management, Tiger Infrastructure Partners. The Aviation Week overview of private equity and general aviation reads like a who's who of the alternative investment industry. These are not fringe participants. These are the institutions that define what institutional quality investment looks like. But here's the nuance that I think is crucial for understanding where the opportunity is right now. All of that institutional capital, Bain, Apollo, KKR, Global Infrastructure Partners, has been focused on the top tier of the FBO market, the highest traffic airports, the platforms with the largest fuel throughput, the national networks with the strongest existing cash flows. They're going after the big established prizes, and that makes sense. If you're managing $600 billion, you need large check sizes to move the needle. What that means for the emerging and middle market is that there's a very real window. The regional airports like Addison, Love Field, Meacham, Orlando Executive, Dallas Executive, Kissimmee Gateway, are not yet fully consolidated by institutional capital. The assets there are smaller, the operations are often family-owned or regionally focused, and the management sophistication is sometimes below what a well-resourced platform could bring. That's the acquisition and development opportunity. You build positions at these airports while valuations reflect the current seller profile, and you exit to the Bains and Apollos of the world who need to grow their platforms with quality assets in supply-constrained markets. The entry and exit thesis are both supported by the same institutional validation.